In the glittering world of 1980s retail, few stories capture the reckless excess of the era quite like the rise and catastrophic fall of Robert Campeau's department store empire. Picture this: a charismatic Canadian real estate developer with virtually no retail experience decides he can revolutionize American shopping by acquiring the nation's most prestigious department store chains through mountains of borrowed money. What followed was one of the most spectacular corporate disasters in retail history, a debt-fueled acquisition spree that would ultimately destroy companies that had survived the Great Depression, 2 world wars, and countless economic downturns. Campeau Corporation's hostile takeover of Federated Department Stores in 1988 for $6.6 billion wasn't just an acquisition, it was retail suicide wrapped in the gleaming promise of financial engineering. Within 2 years, this empire built on leverage would collapse under the crushing weight of $10 billion in total debt, taking down iconic American retailers like Abraham & Straus, Bloomingdale's, and Jordan Marsh, while fundamentally altering the landscape of American department store retail forever. Robert Campeau's journey from small-town Canadian to retail destroyer began in the most unlikely place: residential construction. Born in 1923 in Sudbury, Ontario, Campeau started his career building modest homes in Ottawa during the 1950s, demonstrating an early appetite for debt-financed growth that would eventually prove his undoing. By the 1960s, he had transformed his small construction company into one of Canada's largest real estate development firms, Campeau Corporation, using an aggressive strategy of leveraging each successful project to finance increasingly ambitious developments. His crowning achievement was Scotia Plaza in Toronto, completed in 1988 as Canada's tallest building at 68 stories, a monument to his belief that bigger was always better. But real estate development, even on this grand scale, apparently wasn't enough for Campeau's ambitions. In the mid-1980s, he set his sights on American retail, convinced that department stores were undervalued assets waiting for a visionary like himself to unlock their potential. His first major move came in 1986 when he acquired Allied Stores Corporation for $3.6 billion, a deal that included prestigious chains like Brooks Brothers, Ann Taylor, and Bonwit Teller. The acquisition was financed almost entirely through junk bonds and bank loans, creating a debt service burden of over $400 million annually. But Campeau was just getting started. The Allied Stores acquisition might have been a warning shot, but Campeau's next target represented a full declaration of war on traditional retail finance: Federated Department Stores, the crown jewel of American department store retail. Founded in 1929, Federated was a retail institution that operated some of the most prestigious department store chains in America, including Bloomingdale's, Abraham & Straus, Burdeen's, Goldsmiths, Lazarus, and Rich's. These weren't just stores. They were cultural landmarks that had defined American shopping for generations, with Bloomingdale's alone generating over $1 billion in annual sales by the late 1980s. Federated's management, led by CEO Howard Goldfeder, had built a reputation for conservative financial management and steady growth, with the company operating 650 stores across 33 states and employing over 140,000 people. The company had survived the retail upheavals of the 1970s and early 1980s by focusing on customer service, maintaining prime real estate locations, and building strong relationships with suppliers and designers. When Campeau first approached Federated in late 1987 with an unsolicited takeover bid, management rejected it immediately, recognizing that his debt-heavy acquisition strategy posed an existential threat to their carefully managed business. But Campeau wasn't interested in friendly negotiations. He was planning a hostile takeover that would leverage Federated's own assets to finance its acquisition. The battle for Federated Department Stores became a defining moment of 1980s merger mania, a high-stakes poker game played with borrowed billions while the entire retail industry watched in fascination and horror. Campeau's opening bid of $4.2 billion in January 1988 was immediately countered by a management-led leveraged buyout proposal valued at $4.9 billion, setting off a bidding war that would ultimately destroy the very company both sides claimed to want to save. Enter Macy's, the iconic New York retailer led by the ambitious Edward Finkelstein, who saw an opportunity to acquire his biggest competitor and launched his own $4.7 billion hostile bid in February 1988. For 3 months, these titans of American retail engaged in a corporate deathmatch, with each successive bid requiring ever more dangerous levels of debt financing that would saddle the winner with interest payments approaching $1 million per day. Campeau's financial advisors at First Boston and Olympia in York warned him repeatedly that the escalating price was approaching the mathematical limits of what Federated's cash flows could support. But he pressed on, convinced that his real estate expertise would allow him to unlock hidden value through store closures and property sales. The final bid came in April 1988, when Campeau offered $6.6 billion for Federated, a price that valued the company at nearly 3 times its book value, and required financing arrangements so complex they filled over 1,000 pages of legal documentation. The financial engineering behind Campeau's acquisition of Federated was a masterclass in leverage run amok, a house of cards built from junk bonds, bank loans, and financial instruments so exotic they required teams of lawyers to explain. The $6.6 billion purchase price was financed through a Byzantine structure that included $3.5 billion in junk bonds issued by Drexel Burnham Lambert, $1.8 billion in bank loans from a consortium led by Citicorp and Chase Manhattan, and $1.3 billion in other securities including preferred stock and subordinated debt. This financing structure meant that Campeau Corporation would need to generate over $800 million in annual cash flow just to service the interest on Federated's acquisition debt, a figure that represented nearly 60% of Federated's total operating income in 1987. To make the numbers work, Campeau's financial projections assumed he could immediately sell off Federated's real estate assets for $2 billion, close underperforming stores to reduce operating costs by $200 million annually, and increase comparable store sales by 5% per year through improved merchandising and marketing. These assumptions weren't just optimistic, they were delusional, based on a fundamental misunderstanding of how department store retail actually worked. Unlike real estate development, where Campeau could buy land, build a project, and sell it for a quick profit, department stores were complex ecosystems that required deep relationships with customers, suppliers, and employees built over decades of careful cultivation. The warning signs that Campeau's retail empire was doomed began appearing almost immediately after the Federated acquisition closed in May 1988, but they were initially obscured by the general optimism surrounding leveraged buyouts and the broader retail boom of the late 1980s. The first red flag was Campeau's decision to immediately begin selling off Federated's most valuable real estate assets to generate cash for debt service, including the sale of several prime Manhattan properties for over $400 million to Japanese investors who were paying premium prices for American real estate. While these sales provided short-term cash relief, they also eliminated Federated's most valuable long-term assets and forced many stores into expensive lease arrangements that dramatically increased their operating costs. The second warning sign was the exodus of experienced retail executives from both Allied Stores and Federated, as Campeau's cost-cutting mandates and erratic management style created chaos in the executive ranks. Key merchandising executives, store managers, and buyers who had spent decades building relationships with customers and suppliers began leaving for competitors, taking with them institutional knowledge that couldn't be replaced. By late 1988, Bloomingdale's had lost 3 senior vice presidents in 6 months, while Allied Stores saw turnover rates exceed 40% in critical buying positions. The third and most ominous warning sign was the deterioration in customer service and store maintenance as Campeau slashed operating expenses to meet his debt service obligations, reducing staff hours by 15% across all chains, and deferring routine maintenance that kept stores looking fresh and inviting. The collapse of Campeau's retail empire accelerated dramatically in 1989 as a series of external shocks exposed the fundamental weaknesses in his debt-heavy business model. The first blow came from an unexpected downturn in consumer spending as the American economy began showing signs of the recession that would officially begin in July 1990, causing same-store sales to decline across virtually all of Campeau's department store chains for the first time since the early 1980s. Federated's comparable store sales fell 3.2% in the fourth quarter of 1989, while Allied Stores saw an even steeper decline of 4.8%. Creating a cash flow shortfall that made it impossible to meet the escalating debt service payments. The second blow was the collapse of the junk bond market following the indictment of Drexel Burnham Lambert's Michael Milken in March 1989, which eliminated Campeau's ability to refinance his short-term debt through new bond issues and forced him to rely entirely on increasingly reluctant banks for working capital. The third and final blow was the realization that Campeau's projected real estate sales had been wildly optimistic, as a softening commercial real estate market made it impossible to achieve the $2 billion in asset sales that were essential to his financial projections. By December 1989, Campeau Corporation had missed multiple interest payments totaling over $100 million and was in technical default on most of its major loan agreements. The company's auditors, Deloitte and Touche, refused to provide an unqualified opinion on Campeau's financial statements, citing substantial doubt about the company's ability to continue as a going concern. The final months of Campeau Corporation's ownership of America's premier department store chains read like a corporate thriller, complete with midnight negotiations, desperate asset sales, and a Canadian entrepreneur's growing realization that his retail dream was becoming a nightmare. In January 1990, facing imminent bankruptcy, Campeau negotiated a $250 million emergency credit facility with his existing bank consortium, but the funds came with draconian conditions that essentially placed day-to-day control of both Allied Stores and Federated in the hands of bank-appointed consultants. These consultants immediately began what they euphemistically called right-sizing the retail operations, closing 47 underperforming stores, laying off over 6,500 employees, and liquidating millions of dollars in excess inventory at fire sale prices that damaged the premium brand image Federated had spent decades building. The emergency measures provided only temporary relief, as the company was still burning through cash at a rate of nearly $50 million per month, while same-store sales continued to decline amid growing media coverage of Campeau's financial troubles. In a last-ditch effort to save his empire, Campeau attempted to sell Bloomingdale's to a consortium of Japanese investors for $1.2 billion, but the deal collapsed in March 1990 when the buyers discovered the extent of Bloomingdale's hidden debt and deteriorating operational performance. On January 15, 1990, Allied Stores Corporation filed for Chapter 11 bankruptcy protection, followed just 12 days later by Federated Department Stores, marking the largest retail bankruptcy in American history and the end of Robert Campeau's brief but catastrophic reign over American department store retail. The human cost of Campeau's retail disaster extended far beyond corporate balance sheets and bankruptcy filings, affecting hundreds of thousands of employees, suppliers, pensioners, and communities that had depended on these iconic department store chains for their economic livelihood. The immediate impact was devastating. Over 25,000 employees lost their jobs as Campeau's companies closed 147 stores across the country, with particularly severe impacts in smaller cities where department stores had served as anchor tenants that sustained entire shopping districts. Cities like Atlanta, where Rich's had been a cultural institution since 1867, and Miami, where Berdini's had operated continuously since 1898, saw their downtown retail cores permanently damaged as these flagship stores either closed or dramatically reduced their operations. The bankruptcy also wiped out the retirement savings of thousands of employees whose pension funds had been heavily invested in Campeau Corporation stock, with some long-term employees losing over 60% of their expected retirement benefits. Suppliers throughout the fashion and home goods industries were forced to write off hundreds of millions of dollars in unpaid invoices, with smaller manufacturers and designers particularly hard hit by the sudden loss of what had been reliable revenue streams. The ripple effects extended into real estate markets across the country as the closure of major department stores triggered the decline of shopping malls and downtown retail districts, accelerating the shift toward discount retailers and suburban strip centers that would define American retail for the next 2 decades. The bankruptcy and subsequent reorganization of Federated Department Stores marked the end of an era in American retail, but it also set the stage for the emergence of a new, more focused, and ultimately more successful company under the leadership of Alan Questrom, a veteran retail executive who understood that success required operational excellence rather than financial engineering. Questrom, who had previously turned around the struggling Neiman Marcus chain, was brought in by Federated's creditors in 1990 to guide the company through bankruptcy and back to profitability through a radical restructuring that closed underperforming stores, invested in remaining locations, and rebuilt relationships with customers and suppliers that had been damaged during the Campeau years. The streamlined Federated that emerged from bankruptcy in 1992 operated just 220 stores compared to the 650 stores it had operated before Campeau's acquisition. But these remaining stores were profitable, well-maintained, and positioned in prime retail locations that could command premium prices. Under Questrom's leadership, Federated rebuilt its merchandising capabilities, upgraded its technology systems, and most importantly, restored the customer service standards that had made chains like Bloomingdale synonymous with upscale shopping. The company's renaissance culminated in 1994 when Federated acquired its former rival Macy's, which had itself been severely weakened by the debt load from its failed attempt to acquire Federated, creating a department store powerhouse that would dominate upscale American retail for the next 2 decades. Robert Campeau's spectacular failure serves as a cautionary tale about the dangers of financial engineering divorced from operational reality, a reminder that successful retail requires deep understanding of customer behavior, supplier relationships, and market dynamics that cannot be replaced by clever financing structures or aggressive cost-cutting. The Campeau disaster marked the beginning of the end for the traditional department store model that had dominated American retail since the early 20th century, accelerating the shift toward discount retailers, specialty stores, and eventually e-commerce platforms that could offer lower prices and greater convenience than the elaborate full-service department stores that Campeau had tried to acquire. The massive debt loads that Campeau placed on previously healthy retailers became a template that was unfortunately copied by other financial buyers throughout the 1990s and 2000s, contributing to the destruction of iconic American retail brands from Circuit City to Toys R Us that were driven into bankruptcy not by changing consumer preferences, but by unsustainable debt service obligations. Today, as traditional retailers continue to struggle with the rise of online shopping and changing consumer behavior, the Campeau story serves as a stark reminder that retail success cannot be achieved through financial manipulation alone, but requires the patient building of customer relationships, operational excellence, and sustainable business models that can adapt to changing times without the crushing burden of excessive debt. In the end, Robert Campeau's brief ownership of America's premier department store chains cost investors over $8 billion, destroyed hundreds of thousands of jobs, and permanently altered the landscape of American retail, proving that sometimes the most expensive lessons are those that teach us the difference between building value and merely shuffling assets in pursuit of short-term financial gain.